Today we learned that the Federal Reserve decided to keep interest rates steady, but what does it mean for your portfolio? What does it mean for the economy? And where in the world are we going in 2024? Because I actually read through their entire document and it was some pretty interesting thoughts about where we are headed next year. So you'll make sure you stay tuned for that. Let's go ahead and break it down. All right, as I mentioned at the top of the video, yes, they decided to keep interest rates steady. This is actually the second time out of the last 3 meetings that they have decided to do so. Why is that important? Well, one, it shows that they are aware of the fear of pushing the entire economy off a cliff and into a recession. We've talked about it many times. I don't think we need to go and rehash that entire argument. But the thing is this, they kept raising interest rates. They did so at a pace that was extremely fast. It caused some banks to collapse. I keep telling people, yeah, that happened in 2023. It feels like it was a year ago. It wasn't. That was this year. And there is a fear of doing that. Now, there are some people, I don't know why, they're just rooting for a recession. I generally do not know why you would root for a recession, but they feel like it is absolutely going to be a recession, if not this year, which I think we're safe for 2023. They absolutely think it's going to happen in 2024. The Fed actually disagrees. The Fed disagrees, and if you look at their notes, they expect us to have low unemployment in 2024 and still good, solid economic growth, also measured by GDP, gross domestic product. That's solid. I would like that. It is an estimation, and there are still things that can always happen to throw that off. A government shutdown would be one of those things. Now, in these projections, they did also account for student loan debt and those payments coming back online. We will see what that actually feels like once it comes and how that plays out over the next, 3 or 4 months. The other thing too that you want to know is that they do expect interest rates to increase at least one more time this year in 2023 by 0.25% or 1/4 percentage point. That should be the last, but it is not a guarantee. The Fed also thinks that in 2024, they will start to cut interest rates somewhere around June or so of 2024. Again, these things can shift. Okay, these things can shift based on what goes on in the stock market and what goes on in the economy, but that is the expectation. One more rate increase in 2023. At some point, perhaps mid-2024, things will start to get cut and you're going to see rates go down. This is one of the reasons why I've said for months now, if you are looking to make a major purchase like a home, I would just save in a high yield savings account, get paid 4.5% guaranteed, and just wait until next year. When rates start to come down, you should get a better deal on that exact same house, assuming that it is available. But what else is the Fed telling us? What else is the Fed hinting towards? And what are the things that we should do as investors? As an investor, just stay the course. Just stay the course. This news doesn't tell us to go and invest in a certain area over another. It doesn't really tell us to go and sell anything. If you are in tech, which you should be in 2023, that has been one of the best fields to invest in. Typically speaking, when rates get cut, you start to see tech stocks do even better. Now, again, that's historically. That is not a guarantee. We've had a lot of things happen in the last 2 to 3 years that has gone the exact opposite of historical trends. But if I'm looking at a stock or a company that is on the line of not so profitable but still trying to grow, if they know in 2024 that rates are going to get cut and rates start to come down, they can borrow more money, hire more people, invest in better equipment, and build more stuff and grow their revenue. That is how a lot of companies got built between 2000 and 2015 or so. I don't know if Tesla would be Tesla today if they were paying today's type of interest rates. So it could be a good thing for tech, and we might start to see another resurgence or bull market for tech stocks. We'll see. Okay, it's still 2023 and I don't have a crystal ball, but the cards are there for that to occur. Now, again, I mentioned, or maybe I didn't, but 2024, also in their documents, they predict low unemployment in 2024 and high to normal growth in the economy. There have been a lot of people for more than 2 years now predicting and guaranteeing that there was going to be a recession in 2023. That hasn't happened, and they are now pushing that out into 2024. Now, according to the Fed, they don't really see a recession around the corner. Now, I would argue almost no one is great at predicting recessions, but also I feel like people have been rooting for one. One, why? That doesn't benefit anybody, but also there is no guarantee that there has to be a recession every 4 years or every 5 years. There are some countries, Australia being one of them, that almost never hits a recession, and I think they're on a 20 or even 30-year streak of not having a recession. COVID, being the asterisk there. So there is no guarantee. You don't have to run into a recession. It's not a normal part of the economic cycle, or it's not a required part. I'll say that it's not a required part of the economic cycle, and it is possible, and we're seeing it so far in 2023, that you can raise interest rates, bring down inflation, keep job growth high, and actually still see income raise or increase. That has happened. Hopefully they can extend that into 2024 and beyond. But again, these are estimations and we will see, but they seem to be quite confident in it. The next thing is this: what should you do? Okay, all this information is quite good and informative, but what does that mean for you and your portfolio? Again, as an investor, that side of it, I don't think you should really move. I told you what to do as a potential home buyer, but what if you're not in those two categories? Or what if you're not in the home market, but obviously you're an investor because you're here? Here's the thing. There is, I would argue, I know some people don't like the word free money. I'll say this: there's easy money to be had out there for you right now. If you got cash on the side, if you got cash and a bank that's not paying you, this is that opportunity to move it to a high yield savings account. I've done an entire video on the best ones out right now, many of them paying 4% or more. That's easy money. And you have a, let's say, a soft promise from the Fed. They're at least going to increase that by another 0.25%. Okay, and when they do that, every time the Fed raises interest rates, I get an email from my bank saying, hey, we're increasing rates too. That's just how this works. So this can be an opportunity for you to continue to build up your cash and just get very easy money. Okay, it's guaranteed by the FDIC. You don't have to worry about any market drops. You are going to get your paper. That would be the absolute best move. You want to learn where those banks are, how you can get them, and what they're paying right now. Check out this video right here.